construction spending, but the big news here was that unemployment claims numbers, they were expected at 205,000. They came back at 200,000. Non-farm productivity was expected at 0.7%. It came back at 0.8%. And then unit labor costs were expected at 2.6%, and they missed expectations, coming in below at 2.3%. One of the most interesting things that has gone on here over the last couple of weeks is the fact that as we were coming into the end of March, the beginning of April, and we had hit these giant profit targets on the indices, and we started ripping away from support levels, that one tick front run on the Thursday coming out of April 1st. And the now plus 30-day move, plus 1,000 points that we've rallied, is that the Fed Fund futures at one point were pricing in a rate cut in June of this year, a rate cut in June of this year. And it got pushed out to July and then September and October. And then it moved into 2027, into March and April and June and then July and then September. And then there was a rate cut even at the beginning of this week that was being priced into December 8th of 2027. And then there was a pause. And then it disappeared. The table needs to be longer. That rate cut has been pushed out so far into the future that you can't even see it anymore. And as we were coming out of the daily doldrums yesterday, what we were starting to witness was that this probability for a rate hike started to tick up and had the potential of overtaking the pause. And that's exactly what we've witnessed here this morning. There is now, the Fed Fund futures are now pricing in a rate hike in December of 2027. What that means is that market participants perceive that the increased price of oil, of energy, will have an effect where it will raise the prices of consumer goods and services to where the Federal Reserve will be forced to not only not cut rates, but potentially hike them. And that is not priced into the market. The markets are pricing in pause for longer. Not the beginning of an inflationary environment where, or what would suggest that was needed was the beginning of rate hikes. And so this is a narrative that is fresh, and it is not priced in. Now, what does that mean for our broad markets? Now, we are still going straight up in extension long levels. We have these incredibly bullish setups here. We have had two pro gap up and go situations in a row, which is extremely rare. Normally you'll see a gap up and go in the consolidation day, not another pro gap up and go. Well, we're in another gap up situation, but we're not in the pro gap up and go area or above it yet. The 20 handle here, inside of the 20 handle, we have a probability for a gap fill inside of 68%. So it's a 68% probability that there's a gap fill below us. On Thursdays, there has also been a relatively, over the last 90 days, and especially over the last 30 days, a good probability for filling gaps. And what we were anticipating as we were going into our morning is that if we were below that 20 handle, this stream continues at emoneyaddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.